Alrighty, guys. In this episode, we will be doing two questions as usual, right? First one will be, what can you sell this for? And secondly, what would the exit multiple be? Now, if you want to know the answers, stick with me right now.
Ask Alex. Ask Alex. Because you don't know what you don't know. And if you don't know, now you know.
Yeah.
Okay, guys, let's do the first one now. Question. What can you sell this for? Now, when an investor asks you this question, what do they mean? Okay, it feels like a bit like the investors are saying, sell me this pen, but they're actually not. But they sort of are. They're just trying to figure out how much you want to sell your company for, okay? Meaning like, how ambitious are you? And also, kind of contribute, add to the thinking about what and how an acquisition will be happening, right? And from whom, right? So it's both a sneaky question and a logical one. To get an A, you will need to ground your answer in the realities of your market size and your exit multiples. Now, what do I mean by this? Okay, I'm going to take you through a couple of concepts here. Now, market size. You can't get big if you don't have a large enough market, as you won't have enough people to pay you to make enough money. Okay? Exit multiples. When you have revenue or profit, what we typically call EBITDA, companies are frequently and easily valued as a multiple of that revenue. Right? You pick companies which are similar and trade on the public markets. You divide the market cap by the revenue, by their EBITDA, by the GMV, by their whatever, and then you get a multiple that they trade at. Okay, you then multiply that multiple against your figures. Okay, you can also do this with transactions that have happened in the private market. The problem is you may not know the details of those deals. Okay, investment banks track all these numbers, and they typically, by hook or crook, get some other banker or lawyer or founder or someone to give them kind of details over time. Those things kind of remain private in the bank. Okay, if you can get them, great. Okay, not necessarily likely to though. So if your competitors trade at 10 times in a bear market, then you have that going for you. Right? You could say that the market for carrots is 10 billion and you could access 200 million of that in revenue. So you are at 10x, you're 200, you're a $2 billion company. If you have a market size of 200 million, then you're not going to be able to get 200 million in revenue unless you created and owned the market like forever, okay? Just basically not gonna happen. All right, now I'm gonna teach you something else about how deals get done. All right, they can either be done in cash or shares. Cash is simple. They buy you, and that money goes into your grubby little pocket. Now, they can also buy you in shares, which means that you will own a share of their company, depending on how the deal is structured. Investors may not like this, though, um, basically because cash is clean, right? Shares can be good, depends on who the deal is, but let's not get into it now, all right? You can also be paid in a combination of both two, but this is only really gonna likely happen for like really big deals, okay, where you have investment bankers and shizzle involved, okay? With small ones, they will just give you cash, right? So why does this matter? Well, people need to have the dough to buy you, right? If you're worth 1 billion, then someone needs 1 billion, right? So, your answer can include that the companies you are thinking of would be able to buy you in both cash and shares, assuming they are large enough. All right, to wrap up, once you have shown multiples in valuation, you want to add who has the cash or shares to buy you, right? You finally share a couple of names and then some sort of comments on why that would make sense, like they don't have a mobile strategy, right? Does that kind of make sense? Okay, so what do you need to say to answer this question from an investor, right? Okay, I guess when is important here. B would be prime acquirers, since they both started and shut down their initiatives in carrots. Carrots is a tough business. Now, Facebook, Google, and Apple have about 350 billion, that's with the B, in dry powder offshore. Locally, Y and X have 500 million on the balance sheet. For a couple hundred million exit, we think that's quite reasonable to cover in a cash deal. They, of course, can issue a stock too, but we'll see. This is for a large exit scenario, of course, right? And I know your ROI is time dependent, so a couple hundred million exit in a shorter time period will, I guess, stay to everyone. But that's how we kind of think about it right now. Okay, guys, now, next question. You're pitching a VC, and the VC then says, well, what would the exit multiple be? So what does investor mean when they ask you this question, right? Firstly, you are unlikely to be asked this question. I've included it to help you, ensure you understand what it actually means and kind of round out your knowledge. Now, if you are, then this would be a test to see if you understand your business model and industry and whether you have allocated any time at all to think about the exit, which you should, right? It could also just be the investor asking a random ass question because they are thinking about it and it just came out of their mouth. In the last question, I taught you the basics of multiples. So now use that knowledge. You need to check the previous acquisition multiples in the private market and what companies have been traded on in the public market in your industry. Again, the public market one will be easier, unlikely to get the private market one. So check them before you meet investors. I know this seems like a pain in the ass, but it is really useful to have an idea for what you could be worth depending on your revenue forecast, right? And the process of doing evaluation is already pretty simple, right? When you have numbers. All right, for private multiples, read deal announcements. You can Google whatever deal, someone may slip something in there, right? You probably have to make assumptions to try and get ballpark what they are. You can try calling up investors, friends who are on the deal, probably won't tell you that, but anyway, right? For public multiples, depending on your industry, VCs and brokers will blog occasionally to save you some time. If you're in SaaS, this is the only one which I can really think of, which is pretty useful. Check out one from Bessemer, which I'll put out a link. They do a cloud index for all the public SaaS companies. If you've got a friend in banking, ask them for a broker report. This is getting really hard these days because MiFID rules, but let's not get into it, right? It makes it pretty hard for them to get them, so they're very unlikely to do this, but that used to be a gold mine before. You can always ask. Or you just go to Yahoo Finance. It's the only useful thing I think they ever did. And you can check out the trading multiples one by one for each of the companies, put them in a spreadsheet, get an average, thank you very much, okay? So, as I said, yeah, put them in a spreadsheet, add them up, get the average of the deals, maybe delete the ones that you don't want, be sneaky, right? And you just apply the multiple to your forecast. So if your average says it's 6.7 times, you do 10 million revenue, you're a $67 million company, right? There's some adjustments, but I'm not going to get into it now, okay? Also, just bigger numbers are better. So how would you answer this question if a VC asked you? Do you know? Well, here's an example. 5 companies were bought in the past 3 years between 3 and 7 times approximately. The 7 was for Salesforce, which sells different things to us though. Zendesk was 6x, which is more similar to us. Groupon is trading at 10x, which is obviously higher given the liquidity premium, but it will obviously depend on the industry valuation at the point in time and how strategic potential acquirers view us as being. Now, the SaaS market is currently at about 7x, which is at a down cycle, and historically gets closer to 10x on average in the up cycle. So clearly the rate of growth will impact where we are on that scale and the point in the cycle which we get into. So yeah, we think that a good solid range between, I guess, 7 and 10x is probably quite viable, actually, to be honest. Okay, guys, that's those 2 questions. I hope they found them useful. If they were, shoot me a comment share it with your friends. Send me some candy, whatever. Have a great day, guys. If you want to watch more, keep doing it. Otherwise, check it out on the podcast. Bye.